I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZB. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob, and best of the season.
Best to you, Jim, and I always like our Friday mornings together, so here we are again.
Yes, nice sunrise on the Fraser River here where I am after a very brutal windstorm went through the area. So hope everybody's safe and sound and has their power back on.
Well, it's getting there, but I'm close to a cliff that goes down to the ocean with a direct view, and then along the verge there's a bank of big fir trees. And one of them is a big old one, and the top 15 feet of it was dead, with just sort of short stub branches sticking out, and there's been a pair of eagles hang out there quite a bit, actually. It's fascinating to watch. Well, yesterday, that strong wind from the south, which is rare, snapped the top off that tree, so the eagles no longer have their little spar branches to sit on. But there was one there now it broke off where the tree is still alive, so there's some live green branches sticking out, and they were there earlier this morning. So interesting where you get a snag tree, can be there for so many decades, and then get an unusual wind from the south and bang, over it goes. So, but I wouldn't call it an ill wind. I think we've got ill winds in the financial markets.
Yes, a lot of down days, and now I've just heard an analyst say we should be, if you didn't get out of the equities market, it's too late now. Bob, is there ever such a thing as too late now?
No. It's very difficult to call the top of a market, even when you've been in the business as long as I have, and even when you've got outstanding technical analysis, which we have, and then even when you got a history of every bubble, and you know that it's insane, but like in August, if you write too critically, then they defined you as a bear, in which you have no credibility. So you have to kind of be positive until the last minute, but ours worked out well. We figured we had our friends of the bull market, which were essentially credit markets and industrial commodities. They were supposed to be good through until about mid-year. They were, and then they would start to change. We called it the sunshine, and then figured that after August it would be into twilight, and then in the fall, there'd be probability of the twilight zone, and you'll remember that scary TV series with outstanding plays. So, well, we got the twilight zone, and it's still on. So, but now, Jim, the market is really quite oversold, and in our historical work, we noted that all of the great financial bubbles in history had crashed in the fall of the year that they set their highs, like sensational speculation, and there'd be heavy liquidation down to late October. Yep, check mark on that one. A rebound in November, early November. Yep, we got that one. And then a test of the selling pressures in November, and we mentioned that even in one bubble crash in 1825, the severe pressures continued right through until December the 24th. So this is one of those where the severe pressures have continued into December, but things are kind of getting oversold now. the market highs in 2015, and then we had that sharp sell-off with crude oil down to early 2016. Well, that high in there is sort of a support level. And whether you look at the Dow or the NYSE comp index, we're down to that and oversold. So I think the market will find some stability here and then a probable rally for a while. But the whole tone of the market has changed. When you're in a bull market, you buy the dips, and we have our springboard buy technical model for that one. And then that model now has been altered a little so that on the rallies, you sell the rallies. And it gives what we call a bearish springboard. So unfortunately, the whole aspect of the financial markets has changed, and one has to recognize that change, and you can't fight it. There used to be a saying about don't fight the Fed, but it's much more practical to say don't fight the tape. I mean, the market is much, much wiser than you or I are, and much wiser than a committee of central bankers. So the market is implacably adjudicating the notion that a committee can manage a national economy, which is utter nonsense. So I think once we've had a rebound in here, and at the moment we're not sure how long the rebound can last, but it has the marks of perhaps early stages of a bear market, and one has to adjust for that. But what I'm looking forward to, Jim, is that the public is going to take a look at all of the trillions of their tax monies that were put to risk on a theory that astute central bankers can prevent bad things from happening. And this is now a bad market, so it's not working. So somewhere the common sense of public will look at this and say, hey, these economic theories of intervention are not working. It's going to change, I think. So it's very exciting times. Maybe we might have in Canada and the U.S. the equivalent of the Yellow Vest protest, but this would be perhaps against the nonsense of central banking and interventionist things to, as the saying goes, to prevent bad things from happening. So we live in very interesting times.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, the U.S. Fed earlier in the week hiked interest rates. They're hinting that they'll have 2 instead of 3 hikes in the new year. Does that make a big difference?
No, but it places perspective on what the central bank is doing. In the summer when Trump criticized the Fed for raising the rate, I thought, no, we don't want to have a president instructing the Fed. But then about 2 or 3 weeks later, I thought, hey, this is a good idea, because if we go into a bear market, which we now are in, then Trump will look good and the Fed will look bad. So then here we are, raised it again, and in the face of very weakening or rapidly weakening financial markets, this is just an old bureaucratic knee-jerk there on it. So the interest rates at the short end, like Treasury bills, go up in a boom because there's speculative demand for short-term money, and then they go down. Interest rates go down. So I think that part of the rise in interest rates over the last 4 or 5 weeks could be due to the street thinking the Fed would do another rate increase. And of course, part of it is due to speculative demand for money. But with so many assets weakening, that speculative demand for money will disappear. So this could be the last Fed rate increase. And we want to distinguish the difference between the Fed rate, which is an administered rate, and the Treasury bill rate, which is a market rate of interest that changes every second. And in exciting times like this, the history of the senior central bank is that its move in the administered rate can be 3 or 4 months behind the change in the market rate of interest. So where so many, there's a whole industry out there making their living by commenting on what the Fed's going to do. But when you're in exciting times like we are now, it doesn't matter anyways, because the Fed will follow the market rather than set the market. So, in the trends on short-dated interest rates like T-bills, when they get going, they just keep going until then they quit. So my guess, Jim, is that the T-bill rate is very close to rolling over and starting to decline. And then when that then is set, which could be over the next 5 or 6 weeks, then maybe 3 months after that, the Fed would then start talking about lowering rates. So it's the business of central banking is such a hoax and such a fraud. And I'm sure that many of the central bankers themselves in the game are naive about it. They really think they're running things, and then they find the markets going against themselves, and then they find an excuse for it. So it'll be fun to watch.
We'll have more with Bob Hoye right after the break.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, taking a look at the U.S. Treasury bills on the 19th, the 2-year was 2.65%, so was the 5-year. And the 10-year was 2.18%. Should we be worried about that?
Well, that's kind of a touch of inversion, and you can get in every business expansion. Again, this hinges upon the speculative demand for short-term funds, but it drives the short rates above longer-dated rates, and that then is the curve inverted. But we argued last summer that watch the 5-year to the 30-year, that it didn't need to actually invert. All it needed to do was reverse, and it had reversed by end of September. Then that made the market vulnerable or it was an indicator that the stock market was vulnerable to discovery of liquidity problems, which indeed did happen. So, and then now here you've got at the near end some inversion, but the key was the change from a flattening curve late in the summer, and also there was a change to widening credit spreads. So, but you know, Jim, the fascinating part, again, to jump on central banks, is that while everybody considers that they are determined what interest rates are going to do, but when you look at what markets set, which is the credit spreads, difference between high grade and low grade bonds, and the curve, which is the difference between longer term and short term maturities, hey, they change all on their own, and you now have more than 100 years of history whereby the Fed was supposedly in control. I'm going to mention it again, Jim, that part of the proposal behind forming the Fed was it would be able to be there as a lender of last resort, and it would prevent the financial setbacks that precede recessions. So in their minds at the time, the recession had been eliminated. And then when I got into the business in the mid-1960s, actually 1963, but I remember 1965, the economists then had mainframe computers and their models, and they were absolutely convinced that they could eliminate the recessions. Well, there's been 18 recessions since 2014 when the Fed opened its doors for business. So it doesn't work. And somewhere the public's going to realize it doesn't work. So at any rate, for all of these guys in the investment business that spend so much time and make so much money talking about what the Fed should do or would do or might do, it's completely wasted because the Fed's behind the market. So here we are. The stock market has had about as hard a whack as you can get at the time of the year when liquidity problems can appear. But, Jim, one of the best lines I read in reporting was in The Economist magazine during the same pressures in the fall of 1873, where it was a mighty whack to the markets. And The Economist wrote that while the panic may be over, the results of the panic are not over. And then you went into a 5-year bear market on that one, and it was the beginning of a Great Depression. As a matter of fact, senior economists in England, and by 1884, with, by then you had at least one business cycle in and a recovery, but it was poor recoveries. So they then, in 1884, started calling it the Great Depression. And it lasted until the last short-term business cycle bottom in 1896. But these senior economists in England were still analyzing the Great Depression from 1873 to 1896 on how it could have been avoided, da-da-da-da-da-da. And then all of a sudden they discovered, there's another Great Depression. But economists don't like to talk about history. They prefer to talk about theories, and those theories have very little to do with reality. So we're looking here soon where a whole lot of economic theories are going to go into the trash can. So while a bad market can be unpleasant, there's going to be an ancillary side to it which could tremendously reduce the intervention by, let's call them absolutely mad central bankers, but they won't be described as mad until we're into further contraction. But that's what our outlook is. we could see some rebounds out of a bottoming process over the next few weeks, and rebounds into the first quarter. Industrial commodities. You might have a slightly more favorable on credit markets, and a bounce in the stock market. So, nothing ever goes straight down forever, and things are very oversold at a time when a low was possible. So, very fascinating markets.
Bob, next head of the New York Fed, is quoted as saying, "It's not our job to take away the market's pain." Does he finally get it?
I would have to read that article, but he's not to take away the market's pain. Whereas in 2007, 2008, in that disaster, they were doing everything they could to inflate credit. Desperate. They had all kinds of phrases for it, TARP, and I can't even remember what they were, but they were bound. But the market has been interesting because some big high-flying stocks are down in the order of 50%, but the major indexes are sort of down 18%. So it's not as heavy as the market was in 2008. Remember that in 2007, the high was in the middle of October, and it wasn't until January that people started saying, "Oh, this market's bad." Then it recovered till around May of 2008, and then then it started to get serious pressure. So, and widespread. So we're not at the point where it's bad enough that the Fed would start panicking and shouting and jumping around and saying they're going to rescue everything. So the statement you made seems to be sort of saying that perhaps the guy who uttered it is thinking, well, we don't have to fix the markets, but when it gets worse, they will then be inspired to fix the markets. So,
Bob, all the best to you and yours.
Yep, you have a good Christmas, and I see that the forecast is for sunshine on Christmas Day, which would be rather nice. And
as meteorologist Russell Cates said, we only get a white Christmas in Vancouver 1 year out of 9.
Is that the number on it? Well,
yes.
There's not that many, and but at least it'll be sunny, and that'll be rather nice.
And we know when we have a white Christmas, they don't know how to deal with it at City Hall anyway. Of course, Gregor Robertson was never around to see the bad weather, so. Yeah.
No.
Okay, thank you, Bob.
Yep. Okay, Jim, and we will talk to you next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howstreet.com. You're listening to HowStreet.com Radio. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Best of the season.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.